The processing of lithium is insane.
The price of lithium has really shot up. What used to be $11 a kilogram to more than $80 a kilogram.
There's like software margins in lithium processing right now. I would really like to encourage, once again, entrepreneurs to enter the lithium refining business. You can't lose. It's licensed to print money.
Welcome back to Rockstock Channel, and thanks for checking in. Today's video focuses on Tesla's Q2 earnings call last Wednesday, and its very high relevance for lithium in particular. I have edited a bit more than 3 minutes from the call and interspersed my commentary. As I always say in these videos, I am not a financial advisor, and nothing I say should be construed as investment advice. Please do your own research. I noted in my presentation at the Fast Markets conference last month that Tesla's first quarter earnings call mentioned lithium 27 times and contained the most bullish statements I've ever heard them say about lithium. Lithium was mentioned last Wednesday 24 times, and Elon and Drew continued to hype the attractiveness of the lithium business. I hate to sound like a broken record. I hate to sound like a broken record. I hate to sound like a broken record, but the main takeaway from Tesla's earnings call as it pertains to lithium is the song remains the same. Buy the dip. The song remains the same. Buy the dip. The song remains the same. Buy the dip. I have been narrating stories about upstream raw materials companies since I founded RK Equity 20 years ago. I learned at the knee of the master, billionaire mining entrepreneur Robert Friedland. My audience for most of my career and today are sophisticated institutional investors. But this so-called smart money is often very stupid. They were wrong for so long on Tesla, and they largely haven't taken the time to truly understand niche specialty chemicals materials powering the energy transition. But that doesn't stop them from using their big megaphones to spread fear, uncertainty, and doubt, and take down equity valuations with rapid speed. We highlighted in our last video with Simon Moores his Benchmark Minerals intelligence team's detailed ripping apart of the reckless bear lithium call from Goldman. Passionate Tesla investor enthusiasts creating YouTube content have developed huge followings and have been so right about the Tesla investment thesis. Rodney and I started Rockstock Channel in 2020 as an evolution of the Lithium Ion Rocks podcast begun in 2019, which itself was an evolution of the Lithium Ion Bull newsletter I started in 2016. Mixing an homage to the ordinary man, Joe Sixpack, with a futuristic cartoon from my youth, the Jetsons, I conceive our target audience for Rockstock Channel, you, as Jane and George Battery Pack. Everything about Elon and Drew's commentary in the Q2 earnings call reinforce 4 key mantras. Go long what Tesla is short. Go long what China is short. Commodity equities follow commodity prices, sometimes with a lag. And not all lithium is created equal. 2.5 weeks ago, when we restarted making videos after a near 3-month absence, I articulated a stretch goal to reach 20,000 Rockstock Channel subscribers in a year's time, more than 5 times our approximately 4,000 subscribers then. We've made 4 videos since and have grown to 4,300 subscribers, so about 75 new subscribers per video. At this rate, we would have to make 213 videos over the next year to reach 20,000 subscribers, about 18 videos per month. You can do better. Like Tesla and all disruptive phenomena, Rodney and I are not looking for linear but exponential growth. Please help us by not only subscribing, but telling all your investing friends to subscribe. And make sure to like, and more importantly, to comment on all our videos, as this will help catalyze the YouTube algorithm to serve up the videos to a broader audience. Please also follow us on Twitter and LinkedIn, and like and share and retweet our LinkedIn and Twitter commentary on those platforms. After a long period of disinvestment amidst investor disinterest, a long commodity supercycle is underway, in my opinion. Valuations are very low. Big mining, big steel, and oil producers are generating massive cash flows, which continue to be returned to shareholders through high dividends and share buybacks. But investments in growth and M&A is underway and is poised to accelerate rapidly. we see a disconnect in private market valuations to public equities. Ganfeng Lithium bought 2 weeks ago a private Argentina brine asset for $962 million, nearly 10 times what the seller plus petrol paid in 2019. This follows Rio Tinto paying $825 million for a different Argentina asset in December, for which Ford announced last week a non-binding MOU to partner with. There are many Argentine and Chilean brine projects on Arche Equity's Lithium Equity scoreboard that are more advanced and arguably of higher quality than these assets, such as Lithium Power International, which now owns 100% of its Maricunga project in Chile, and Galan Lithium in Argentina. At less than 250 million market caps, LPI and GLN are trading at 75% discounts to the valuations Ganfeng and Rio Tinto paid. The niche upstream raw materials powering the energy transition is one of the key secular investment themes of our time. The vast majority of my investments are in equities of this type: miners, processors, and developers of hard assets. Like Tesla several years ago, Jane and George battery pack retail investors who educate themselves about this sector generally, and individual companies in particular, have an opportunity to accumulate life transformational wealth.
People often ask me if is some breakthrough needed in battery technology for the world to transition to sustainability. The answer is no. Even if there was zero technology breakthroughs, literally zero, from where the technology is right now, we could fully transition Earth to sustainable energy. The issue is very much the rate at which the entire supply chain, from mining to refining to cell production, how fast can that grow? It's growing fast, but the faster it grows, the faster we transition to a sustainable energy economy.
A lot of these, higher energy density technologies are not necessarily scalable. I mean, most of them are not scalable from what I've seen. And so focusing on them is a distraction from the mission. It really is, how do we scale as fast as possible? And, we're taking these risks that we've discussed at Battery Day, and our plan is, as we de-risk them and they are successful, we want to bring them back to our partners so that they can go faster too, because that's all on the mission.
The fundamental rate limiter for Earth transitioning to sustainable energy is how fast can you grow lithium-ion battery output per year? Because you need the batteries for two of the pillars of sustainability, the stationary storage and for vehicles.
Elon and Drew are essentially saying here that it is the ubiquitous lithium-ion battery, the 30-year overnight success since first used in Sony camcorders, has reached the tipping point for mass adoption. No new technology is needed to displace lithium-ion battery. Not solid state, not sodium ion, not vanadium, nor any other battery technology. The only challenge is how fast we can scale production of lithium-ion batteries. And if Tesla suppliers up the supply chain can't scale fast enough, then Tesla will do it themselves, alongside their suppliers, and then share their learnings with their suppliers to fulfill their mission for a sustainable future. Tesla's 4680 is simply a new format of the lithium-ion battery, aimed at exponentially scaling production. As Elon and Drew rightly point out, the 4680 and all other battery and EV manufacturing can only move as fast as the slowest point in a long supply chain. And it is mining and refining of lithium in particular that is the luckiest or unluckiest, depending on where you sit in the value chain, limiting factor for scaling adoption. Elon continues to talk about lithium-ion batteries not just as the key technology for electric vehicles, but for energy storage as well. Many commentators, myself included, believe it could be a waste of scarce lithium to use it where its lightweight attributes are less relevant, that is, grid-scale storage, and that other technologies like vanadium or sodium or other technologies using less scarce, less expensive raw materials would be preferred. But Elon seems to be betting exclusively on lithium-ion, which means grid-scale storage may be an underappreciated demand driver for lithium. Don't bet against Elon.
The processing of lithium is insane.
The price of lithium has really shot up. What used to be $11 a kilogram to more than $80 a kilogram.
I'd like to once again urge entrepreneurs to enter the lithium refining business. The mining is relatively easy. The refining is much harder. It's basically like minting money right now. If you there's like software margins in lithium processing right now. I would really like to encourage, once again, entrepreneurs to enter the lithium refining business. You can't lose. It's licensed to print money.
Elon's right that software-like margins are achievable in lithium. Allchem, Pilbara Minerals, Mineral Resources, AMG, Advanced Metallurgical, Albemarle, Livent, and SQM should indeed be minting money this year from their existing lithium production. Many entrepreneurs, as well as big mining, big oil, big utility, and others, have been heeding Elon's wishes long before he implored them, enticed by the dream to obtain a license to print lithium money. However, unlike software, lithium, like auto manufacturing, is a very capital-intensive business. Elon rightly talks about the complex machinery required for lithium processing and the difficulty to make high-purity battery-grade hydroxide and carbonate. It is not easy nor quick to scale lithium chemical production. Greenfield investments and brownfield expansions require large but not insurmountable amounts of risk capital. Like Tesla's Berlin and Austin gigafactories, lithium mines and refineries will spend years as money furnaces before reaching steady cash flows, which means that very high incentive pricing of lithium is required for at least the rest of this decade. Consider too that lithium has been a license to go bankrupt. Altura, Alita, Nemaska, and North American Lithium. Shrewd investors who picked up these assets, including Pilbara Minerals, Pallinghurst, Livent, Sayona Mining, and Piedmont Lithium, are poised to mint money from turning around these brownfield assets. Many other developers survived the last downturn and are somewhere along the path of drilling, designing, engineering, raising capital, and getting permitted their proposed refineries and/or mines. But that path can still be 5 to 10 years more or longer. We have heard little from Tesla about their Nevada clay technology since Battery Day. Lithium Americas, now in year 13, in developing their fully permitted clay project Thacker Pass in Nevada, will hopefully hear positively next month that their project will not be delayed further due to lawsuits and appeals. And in a few years, and after not insignificant $1 billion plus invested capital, hopefully they'll qualify with auto OEMs with battery-grade carbonate and hydroxide. Will Tesla or Ford or other OEMs write risk capital checks to Thacker Pass to guarantee supply security? Will Lithium America's cost profile enable it to mint money? Will they share some of this margin with the OEMs who fund them to help reduce the cost of their EVs? I believe the answer to these questions is yes, yes, and yes. Nothing about lithium is easy. Elon talks about mining lithium, which seems to imply a focus on hard rock spodumene. This is understandable, as spodumene is where Tesla has largely focused their lithium supply sourcing. Recall Elon saying in the past he gets his lithium from Australia. That is hard rock. In contrast to other OEMs, Tesla has not signed any offtakes with geothermal lithium or any DLE or unconventional resources. Offtake deals with Piedmont, Core Lithium, Liontown, Kidman, and Wesfarmers demonstrate Tesla's confidence in spodumene. Though admittedly, Livent is a supplier from brine in Argentina converted in the US and China. Elon says mining is easy, which is not exactly true, but of all types of lithium, plain vanilla spodumene has proved to be the most reliable, scalable, and has been brought on relatively quickly with relatively low capex. I would argue that these easy attributes make spodumene miners and developers perhaps the easiest way to make money in lithium. Refining is indeed difficult and has lower margin, unless vertically integrated with a resource owned by the refiner. As Lucas Sam, ex-CEO of Albemarle, argued on a Lithium Ion Rocks podcast in 2019, it all starts with the resource. This is why Ganfeng, which made its name as a converter of other people's rock and brine, is so aggressive acquiring its own resources. Many entrepreneurs are attempting the refinery without feedstock business plan, many of them private. In Europe, for example, there is Aurora Lithium, a joint venture of Northvolt and Portugal's Galp, There's Green Lithium, La Vista, and others. Rocktech Lithium came on the scene strongly last year with a small investment by Elon Musk's PayPal co-founder Peter Thiel. But the economics of their merchant refinery, PEA, looks challenging considering the high cost of spodumene. And their Ontario spodumene project is much further behind the much higher quality Frontier Lithium, in my opinion. The most credible refinery player in Europe, in my view, is AMG, which is planning 20,000 tons in Germany to be fed from their 130,000 ton spodumene production in Brazil. But they too will need to source new spodumene to implement their 100,000 per year hydroxide strategy. Albemarle and Tianqi's Western Australian refineries at Kemerton and Kwinana will become important suppliers in the not too distant future after years of delays and cost overruns. It's been nearly 4 years since entrepreneurial West farmers bought Kidman to partner with SQM, with no clear articulation yet when their integrated mine and refinery will come online. In North America, Albemarle recently outlined a bold new 100,000 ton refinery alongside their path to 500,000 tons from Western Australia and Chilean operations. This too will be hard rock. Livent is in the process of closing their buyout of Pallinghurst's stake in Nemaska, giving them 50% control of that project, and no doubt they'll be articulating soon plans for an integrated mine and refinery similar to Piedmont and Sayona in Quebec. Allchem too at James Bay.
Elon, you always mention, this 50% per annum sustainable growth target that you guys have. You were calling for entrepreneurs to go into the lithium business. And so does that mean you don't have enough lithium secure to grow 50% per annum over multiple years?
This is a very key question from Pierre Ferrago, a prominent Tesla analyst at New Street Research, that gets directly to a fundamental underpinning of Tesla's valuation. Can the company continue to grow EV sales 50% per year, or might lithium or some other supply chain constraint prevent Tesla from achieving this despite the fact it does not have a demand problem? Drew's answer was that Tesla shouldn't have a problem for the next year or two, but in 10 years, it will have a problem unless their suppliers, new entrepreneurial entrants, or Tesla themselves solve the problem.
And it's not like we have a problem in the next year or two. But when we look 10 years out, yeah, we need to do more to accelerate the growth.
We do see constraints in refining of the materials necessary for lithium-ion batteries. Refining of the lithium into ultra-high purity battery-grade lithium hydroxide and lithium carbonate is quite difficult and requires a massive amount of machinery, and it's a hard thing to scale. If you were to say today, what are concerns, a few years down the road, the machinery to refine the critical ingredients of lithium-ion cells. So the lithium itself, and then the cathode.
In the Q2 call, Tesla articulated not only lithium, but to a lesser degree, cathode, as well as anode manufacturing as a supply chain bottleneck. Drew referenced definitively that steel for Tesla cathode facility was already going up and visible from flyover.
And that is why we are making our own investments. Like we are building a cathode facility here in Texas. The steel is going up. You can see it in the flyovers.
And as it relates to lithium, recall, they said 2 years ago they'd be making lithium hydroxide as well as exploring salty clay. Drew said, much less definitively, in my opinion, we are working on lithium refining activity as well ourselves.
We're working on lithium refining activity as well ourselves.
Actions speak louder than words. I'd love to hear more details on Tesla's lithium hydroxide from spodumene and/or salty clay. But I read Tesla's words in the Q2 call as a call to action for all lithium investors. Go long what Tesla is short. The balance of power, software margins, are with those who own the resources, not the refiners, unless the refiners also own their own resources. Those who own resources and can bring them online before 2025 are in excellent position to mint money. There are many assets under construction from incumbents: Albemarle, Ganfeng, Tianqi, Livent, SQM, Allchem, AMG, Pilbara, Mineral Resources. I predict that all of these stocks will reach all-time higher love before 2025, if not this year. Elon's exhortations in Tesla's Q1 and Q2 earnings calls to produce more lithium is a very clear message, shining a very bright light that Tesla is desperate for lithium, which means every other EV and battery maker seeking to compete with Tesla is even more desperate. For years, OEMs have been asleep at the wheel, to quote Pilbara's Ken Brinsden. Automakers like Ford are now aggressively trying to catch up. Lithium equities have fallen sharply in the past month, in line with many other commodity and other equities on broad-based recession fears. But as Peter Hanna of Fast Markets constructively pointed out last week, lithium prices have largely flatlined over the past month, while other commodities are off 15 to 30%. The stability for lithium starts to look like a strength. Well said. As I look at ARGI Equities' Mr. Market scoreboard, I see best risk reward in lithium equities with a clear and credible path to developing highly profitable businesses by 2025 and are fully funded and/or have reasonable cash balances to weather this risk-off period and await for higher love, FOMO lithium animal spirits to return. Among pure play lithium developers, there is only one fully funded brine asset due to come online in the near term. Lithium America's Caucharí-Olaroz in partnership with Ganfeng. As we saw in the Lithium 2.0 cycle, plain vanilla spodumene projects are the quickest, least expensive, and least risky means to get lithium units into the system. There are lots and lots of Chinese entrepreneurs who have entered the lithium refining industry over the past decade. In fact, this useful chart from Bloomberg shows there is excess refining capacity in China. Whether it all will qualify for battery-grade carbon or hydroxide is another question. With lithium chemical prices in the $70,000 per ton range, these converters can still make decent margins even buying spodumene at $7,000 per ton as per Pilbara's last auction. But it is Pilbara and AMG producing for, say, $500 to $600 a ton spodumene and selling for $7,000 a ton, and new spodumene miners that will be those minting money and making software margins for a period of time. As Rodney keeps saying, it may not be the most fashionable from an ESG or geopolitical perspective, but the reality is that China has figured out refining and can do it a lot more cheaply than elsewhere in the world. Against the excess refining capacity in China, the discipline of Western Australian spodumene producers, largely Pilbara, who took over and mothballed Altura's asset, and the Albemarle Mineral Resources joint venture holding off on selling spodumene from Wodgina in line with Albemarle's refining plans, that have created the wonderful world of spodumene for the next several years. Sigma and Core have re-rated as they plan to sell into this massive bull market for spodumene. Liontown has soared on to $2 billion valuation on credible offtake partners and full funding with cheap debt from Ford, but they will unlikely be in production before 2025. Looking amidst the carnage of developing companies trading 50% or more from their 52-week highs that may achieve higher love, which would represent 100% or more upside, I see several advanced spodumene assets that can get into production and generate cash flow by 2025. In my opinion, Piedmont, Sayona, Critical Elements, Atlantic Lithium, Leo Lithium are 5 developers of advanced spodumene projects that are likely to follow Sigma and Core's re-rating over the past months.